The wealth gap in this country is about to explode. And this is just my prediction and what I think is going on. But I want to talk about this so you can make sure that you're on the right side of it. So why do I think the wealth gap is going to explode? So as we all know, we've seen a lot of inflation, right? Prices for things they keep going up. They've been doing it all year long. At the same time, the job market has been weakening. I know this because I'm in school right now and I've been applying for internships and for jobs that are stable, like accounting jobs. It's been getting super competitive just to get internships, just to get entry-level internships. And so these things, the job market is weakening. And because of this, now we have stocks and different assets at all-time highs. S&P 500 just hit all-time highs. Bitcoin just hit all-time highs. Ethereum just recently hit all-time highs. So what does this mean? This means that assets are going up and up and up, but also inflation is going up and up and up. And on top of that, it's harder and harder to get jobs. That means that unemployment rates are also going up. All of this leads to something called stagflation. And this isn't really supposed to happen. Stagflation is when unemployment rises, but also inflation rises. They're usually inverse. Usually if you see inflation rise, unemployment goes down. So people have jobs and they can pay for the inflated prices. Or if you see unemployment going up, usually you see inflation going down. Stagflation is very, very bad for the economy. And so what's expected to happen, the Federal Reserve is meeting, I think it's like September 15th, 16th, and 17th. And this is where they decide if they're going to lower interest rates or if they're going to raise interest rates. Now, this is a really big deal because when the Federal Reserve lowers interest rates, they usually do this if they see that the economy is slowing down. They'll lower interest rates. And so the reason why they do this is because when they lower interest rates, it means that people and institutions, companies, are able to borrow money and it costs them less to do it. So the interest rates on the loans that companies get or that people get are lower. It means that you borrow, the interest rate that you get when you go buy a new house will most likely be a little bit lower than it is now. But also institutions are able to borrow a lot of capital and then deploy that into the market. It also means that the yield that people get from having their money parked in government bonds is lower. So people will take their money out of bonds and out of these secure assets because it's giving them a lower yield. They're getting less. And they'll take their money out of it and they'll put it into stocks and they'll put it into other assets like crypto, stocks, companies. So it's expected that the Federal Reserve is going to cut interest rates because of the inflation and because of the job market. But at the same time, we just hit all-time highs in all these assets. So if they cut interest rates and then institutions take their money out of things like treasury bills, like T-bills, and then they start putting them into these other assets that already hit all-time highs, it's just going to drive the price further and further up. These assets are going to become more valuable, and the rate cuts over time will lead to more inflation. So it's going to create even more inflation long term. Short term inflation will go down, but long term inflation most likely will go up. And so this is what's going to cause the wealth gap to get even bigger exponentially faster. Because if you're somebody who just works for your money, you go to your job and your pay rate isn't matching inflation anymore, and all you do is you just go to your job, you try to save some money, and then you're buying things, you're consuming because you have to live. You have to buy groceries, rent, clothes, food, gas, vehicles, transportation, things like that. All that stuff is going to cost more. It's going to cost more. your pay is going to stay the same. So this means that you will have less money, right? Simple math right here. The way to get on the right side of this equation is to become one of the people who is owning the assets. You want to own the assets that are appreciating. I think over the next, this is just my prediction, 10 to 20 years, 30 years, this is just going to become more and more exponential, this wealth gap. And it's to the point now, this has already been happening. This is why it's so hard for the average person to just buy a home. I live in California, forget about it. If you're just trying to work your regular job at like Target and then buy a house in California, it's not happening. Not happening. Because the prices are so expensive and the interest rates are high. And because of that, you're looking at, on average, like $5,000, $6,000 mortgage payments for 30 years. And it's like, who's doing that to buy a 2-bedroom house? And so we want to own assets that are going to ride this wave and appreciate in value so that you're not stuck on the side of inflation going up and eating away at your fixed income. But for a long time, I was looking into doing this with real estate, but it's just the barrier to entry is so high there now. So what are some other assets that you can own? And I'm not saying that this is what you should do. This is not financial advice. This is just my opinion. Some other assets just off the top of my head that you can own that will ride this wave are securities and equities. So basically stocks, because you're buying a portion of the ownership of companies. Or you can put it in index funds, and those index funds or ETFs are buying the ownership for you, and they're going up and down with the ownership that they're buying. So stocks, ETFs. Other valuable assets is like cryptocurrency, Bitcoin, Ethereum. You have the blend of those two, which is treasuries that are publicly traded. Things like Strategy. These are different stocks that are treasuries that own, their whole goal is you buy the stock, they take the money that they get from selling the stock, and then they buy digital assets, which is like Bitcoin. Because Bitcoin goes up in value over time, it's a store of value, then your stock price goes up as Bitcoin goes up. They have there's multiple treasuries that do this also for like Ethereum. But these are different things. We need to start owning things. If you don't start owning things, it's going to be harder and harder to own things in the future, is what I'm trying to say. And if you don't make the move to start owning things that are going to appreciate in value now, good luck in the future. So I hope this was helpful. This is just a rant about what I see going on in the market. In case you're wondering who the hell I am, and like I'm just some guy sitting in a car. But like I've been doing this, right? Like, over the last year, I've put somewhere around like 26 or 25K into different stocks and equities, and it's grown. It's gotten to the point where it's 33,000 now. So the investments are growing, and I'm like, okay, people think that this is what rich people do with their money, but no, this is how rich people got their money. You don't have to like become rich doing something else to start doing this. You could just start doing this and be on the path. And so my whole goal with doing this stuff is so that I don't have to work every single day for the rest of my life. I want to be able to retire at a certain age and know that my money makes me money, and then that's enough for me to live off and be cool. And I think that this is really becoming the only way to actually be able to do this. Hope this helps. See you in the next video.